Welcome to the BF Anderson Technical Report for December the 9th. Let's get right into the charts. Nasdaq. Here's the Nasdaq. We're seeing a consolidation period, a big drop going into the election. I don't know if y'all remember this, but the month of October was pretty much a disaster. Everything went down about 5% in the month of October. Then the beginning of November going into the election, we had like 10 days in a row, which was really a shakeout. Then we start to see the results of the election, and the Nasdaq has now broken out. However, the real news here is in the area of the mid caps and the small caps. We'll get to the small caps in a second. The mid cap stocks, which are middle-sized companies. Now, the big change coming here is where the consensus trade, which is all the real large mega cap companies, their stocks are starting to underperform this market, whereas the smaller companies are starting to break out. Now, this is a smoke up the chimney type of formation. Very, very powerful breakout on the mid caps. Here's the New York Composite, which is basically industrial-based companies. It's breaking out as well. But here's the big story. Small caps. Small caps are breaking out in a big way. So think about the rotation here. And rotation is definitely taking place where you're getting away from the index funds. The index funds all are loaded up in the same stuff. Philip Morris, Clorox, Johnson & Johnson, Exxon, Amazon, Facebook. All these index funds have the same stocks, and they're over-owned. And now that we're starting to see some relief in the economy, whether it's due to the election or whatever, small business is starting to get a break here, and we're starting to see a rally. So if you're locked into the index fund mentality, you're going to have trouble here. Now here's the S&P 500, which is also breaking out as well. Looks very positive. Now the most important thing right now, in my opinion, is a potential reversal upward in interest rates. Here's the 10-year Treasury. Now realize the 10-year Treasury has dropped over the last 8 years, has dropped from 5% all the way down to under 1.4% in July of this year. Now, if you're going to make America great again, which is the theme, the campaign theme of the Trump organization, you're going to see higher interest rates if there is deficit spending, which may be the case. Now, right now, the 10-year Treasury yield, and I just noticed the magnitude of this up move here, very dramatic, similar to what happened back here in 2013. What happened in 2013, 2012 was the economy started to pick up steam again, but then right around the beginning of 2014, the wheels came off and the economy just started slowing again. Now, why? I have my theories, but it's irrelevant what my theory is. The fact is the economy started decelerating and interest rates dropped. See, when interest rates drop, that's just an indication that the economy is not doing well, that there's no demand for capital. So the important thing here is the 10-year Treasury yield broke the trend line, the downtrend line, very dramatically, and then is now coming out of a consolidation box. I'm looking at it this morning. We're roughly at a 2.4 yield on the 10-year Treasury. I believe a breakout will come at 2.5, and don't be surprised if we don't rally up to as much as 3%. This is going to be a very positive thing. Now, a way to kind of understand the rotation is to sit here and look at the price of copper. Copper has always traditionally, over the years, been an indicator of economic activity. But what's different this time on this particular bull market is it's not being led by Silicon Valley. It's being led by the Rust Belt. And you can see here with copper breaking out, this is a dramatic breakout in copper. I mean, straight up. And this is right after the election. So what copper is telling us is that the industrial sector is going to lead, and this is not Silicon Valley. This is Indiana. Now, just to kind of take a little trip through history real quick here, just remember, the market, rallied dramatically back in the 90s, and then we had the 2000 top, We then had the bear market, and this was a bad bear market. It really was. And so you can then see the bottom where you got the consolidation, and then you got the new uptrend. Then we get the housing bubble down again, really bad. I mean, this drop here, guys, just realize, and gals, that this was as dramatic as the Great Depression drop in 1929. I mean, the big difference between this drop and 29 was we were smart enough to figure out how to maintain the banking system, whereas in 29 you had 90% margin where people were buying stocks on 90% margin, and when the stock market collapsed, you lost the banking system, and so it just took forever to come out of it. Well, then we start to get a new uptrend that was started, but this uptrend was all based on the fact that interest rates went from 5% to 1.4%. So what has worked here, in my opinion, will not work here, because what's happening now is we're starting to see a new bull market that is going to be driven by earnings growth, whereas this last bull market was driven by interest rates dropping, which is just not a sustainable way to build an economy. So just to kind of cover a couple of things here, the market moved sideways for 16 years, and also during this period as well, people made a lot of money in bonds. And so one of the things to think about on the rotation is, and like here's the 20-year bond fund. Bonds have been in a bull market for 36 years. And there's a lot of money in bond funds. And so as we see interest rates rise and these bond funds start to have difficulty making a return, you're going to see a major rotation out of bonds into stocks. Also, if you think about this, look, here's Clorox. Now, we're talking, pretty basic stuff here. Very defensive. This stuff is what's done. This is the kind of stock that has done real well over the last 8 years. But it moved sideways for 12 years. So you got an up move in the stock, but it looks like to me that this kind of thing is starting to break down. Let's go here. Hold on. Let's see. Okay, now just to kind of cover another group, here's energy. Now, energy, meaning oil and gas production, has had a major bear market. In 2015, the energy stocks dropped 50%. So they've had their bear market. This is a Permian Basin producer. You can see where it moved sideways for an extended period of time, all through 15, drop, sideways, now breaking out. Now what we're seeing here is a rotation into things like steel, concrete, trucking, transportation. In fact, the transportation index made an all-time new high 2 days ago. When the Dow Jones Transport Index is currently at 94.21, it broke out at 9,200. Now that's a Dow theory buy signal. Now Dow theory, again, we've talked about this, is where the Dow Jones Industrial Average makes a new high and is confirmed by a new high in the transports, which means that goods are going to be manufactured and moved around the world. Now, here's an example, steel. We're seeing a major upturn in steel. Now, just to make a final note here, China really doesn't look very good. I think I would just have to take a real wait-and-see attitude about China. So in conclusion, what I'm trying to get across is we're seeing a rotation into things like energy, concrete, trucking. It's a completely different ballgame. And I will say, over the last 30 years, I have always noticed that bull markets, when they get started, are usually led by Silicon Valley. This time is different. So if you have any questions, please give me a call.